Hi everyone, I'm Preeti.
And I am Tejaswini. We are pursuing masters at Christ Deemed to be University.
Welcome to GoSmart Eco Academy, and today we'll be focusing on
The reporting on green accounting,
metrics and indicators of green accounting,
global reporting initiatives,
carbon disclosure project,
Sustainability Accounting Standards Board, and
the integrated report.
without any further ado, get ready to learn how accounting can contribute to a greenery future. Hello all, welcome to day 5 of Green Accounting. Today we will discuss on some green reporting requirements.
Some countries or regions have mandatory reporting requirements for certain companies, such as publicly listed companies or companies that exceed a certain threshold. These requirements may include reporting on greenhouse emissions, energy usage, water usage, waste management, and other sustainability issues. Such reporting is basically termed as mandatory reporting.
But what if there is no mandatory requirement from the countries? Even if a company is not required to report on its sustainability performance, it may choose to do so voluntarily. Voluntary reporting can be a way for companies to demonstrate their commitment to sustainability and to gain credibility with stakeholders. Such kind of reporting is known as voluntary reporting.
Apart from these two reportings, there are situations where some reporting requirements and eligibility conditions are specific to certain industries or activities. To give an example, companies that extract and process natural resources may be required to report on their environmental impact, and companies that have a significant carbon footprint may be required to report on their greenhouse gas emissions. Such kind of reporting can be termed as eligibility by industry or eligibility by impact.
After understanding the green reporting requirements, it's essential to understand the governing bodies of green reporting. There is no single governing body that governs the law related to reporting of green accounting globally. Instead, different countries and regions have their own governing bodies that set regulation and guidelines for reporting on environmental impact and sustainability practices. These frameworks provide guidelines for what information should be included in a sustainability report and how it should be presented.
Some of the key governing bodies and reporting frameworks includes first one being Global Reporting Initiative. The GRI is an independent international organization that promotes sustainability reporting standards and guidelines. The GRI provides a framework for organizations to report on their environmental, social, and governance performance. Up next, we have International Integrated Reporting Council. The IIRC is a global coalition of regulators, investors, companies, and other stakeholders that promote integrated reporting. Integrated reporting combines an organization's both financial and non financial information, including sustainability performance, into a single report.
Third, Sustainability Accounting Standards Board. This SASB is an independent standard setting organization that develops sustainability accounting standards for use by publicly listed companies in the United States. Next, European Union. The EU has established several reporting regulations, including the Non Financial Reporting Directive, which requires large companies to report on their environmental and social impacts.
Up next, we have Carbon Disclosure Project. So, the CDP is a global environmental reporting platform that provides a framework for organizations to report on their greenhouse gas emissions and climate related risks and opportunities. Moving on, we have Task Force on Climate Related Financial Disclosures. So, the TCFD provides recommendations for companies to report on their climate related risks and opportunities in the financial filing.
Next, Next, we have United Nations Framework Convention on Climate Change. The UNFCCC is an international treaty that aims to prevent dangerous human interference with climate system. The UNFCCC sets emission reduction targets and encourages countries to report on their progress towards meeting these targets. Next, the Environmental Protection Agency. The EPA is a United States federal agency that is responsible for regulating environmental issues. These EPA sets regulation for emission, waste disposal, other environmental impact that organization must comply with.
Up next, we have Integrated Reporting Framework. So, the IRF provides a framework for organizations to report on their financial, environmental, social, and governance performance in a single integrated report. The ISO 14001. So the ISO 14001 is an international standard that provides guidance for organizations to establish and maintain an environmental management system to manage their environmental impacts. Up next, we have Non-Financial Reporting Directive. So the NFRD is a European Union directive that requires large companies to report on their environmental and the social impacts. So, overall, these are the various governing bodies and reporting frameworks that play a role in governing the laws relating to the reporting of green accounting. And this can vary depending on the country or the region.
Up next, we have companies around the world that report on their sustainability performance through green accounting. Here are a few examples. Apple publishes an annual environmental progress report that outlines its environmental impact, including its carbon footprint, energy usage, and waste reduction. Coca Cola publishes a sustainability report that covers a range of environmental and social issues, including efforts to reduce water usage and greenhouse gas emission. Third, Unilever publishes a sustainable living report that outlines its sustainability strategy and performance, including its efforts to reduce the environment footprint and increase positive social impact.
Up next, we have Walmart. Walmart publishes an annual global responsibility report that covers a range of sustainability issues, including its efforts to reduce waste and greenhouse gas emissions. Next, Siemens AG. Siemens publishes an annual environmental portfolio that outlines its environmental impact and sustainability performance, which includes its efforts to reduce energy usage as well as greenhouse gas emissions. Next being Nestle. Nestle publishes a Creating Shared Value report that outlines its sustainability strategy and performance, which includes its efforts to reduce the water usage and as well as the greenhouse gas emissions.
Next, Procter and Gamble. Procter and Gamble publishes a sustainability report that covers a range of environmental and social issues, including its effort to reduce its environmental impact and increase positive social impact. Last, Ford Company. Ford publishes an annual sustainability report that outlines its environmental impact and sustainability performance, which includes its effort to reduce the carbon footprint and increase social sustainability material.
Up next, apart from the global perspective, now it's time for us to understand the Indian companies report on their sustainability performance through green accounting practices. First one being Tata Steel. Tata Steel publishes an annual sustainability report that outlines its sustainability performance and initiatives, which includes its efforts to reduce the greenhouse gas emissions, improving its energy efficiencies, and promoting water conservation. Moving on, we have Infosys. Infosys publishes an annual sustainability report that outlines its sustainability performance and initiatives, which includes its efforts to reduce greenhouse gas emissions, promote energy efficiency, and increase the use of renewable energy.
Next, Mahindra and Mahindra, ITC Limited, Wipro, Hindustan Unilever are few companies that provide an annual sustainability living report which outlines its sustainability performance and initiatives that include efforts to reduce its environmental impact and increase its positive social impact. By now, we would have understood that green accounting is a system of accounting that takes into consideration the environmental impact of economic activities. It aims to measure the cost of environmental degradation and benefits of environmental protection. Here are a few metrics and indicators that can be used to track the progress in green accounting.
First one being the carbon footprint. Carbon footprint measures the total amount of greenhouse gases emitted by a particular activity, product, or an organization. The common greenhouse gases are carbon dioxide, methane, nitrous oxide. Calculating the carbon footprints includes identifying and measuring the emissions from all stages of an activity's life cycle, which includes production, transportation, and disposal. Carbon footprint calculations can be used to identify opportunities for reducing emissions and track progress in reducing the greenhouse gas emissions. To just give an example, a company might calculate the carbon footprint of its manufacturing process to identify the opportunities that is available for them to reduce greenhouse gas emissions. It might switch to a renewable energy sources or improve the energy efficiency of its operations.
Next, energy consumption. Energy consumption is the amount of energy used in the economic activities, including manufacturing, transportation, and heating, cooling of buildings.
Up next, we have water footprint. A water footprint measures the total amount of water used by the economic activity, including the amount of water used to produce the goods or services and the amount of water that is used for consuming the activity. Water footprint calculations can help identify opportunities for reducing water use and improving water energy efficiencies. To give an example, a beverage company might calculate the water footprint of its products to identify the opportunities for reducing water use. It might improve water efficiency in its production process or work with farmers to reduce use in agriculture production. Up next, we're moving to waste generation. Waste generation measures the amount of waste produced by an economic activity. This includes solid waste such as packaging and discarded products, as well as the liquid waste that is the water waste. Measuring water generation can help identify opportunities for reducing water and improving waste management practices.
Next, we have natural resource depletion. The natural resource depletion measures the amount of natural resources used in an economic activity that includes minerals, fossil fuels, and forests. Measuring natural resources depletion can help identify opportunity for reducing resources usage and improving resource efficiency. A mining company might measure its natural resource depletion to identify the opportunity for reducing resource usage.
Up next, we have environmental expenditure. Environmental expenditure measures the amount of money spent on environmental protection or restoration activities such as pollution control, waste management, ecosystem restoration. Measuring environmental expenditure can help identify the cost of environmental degradation and the benefits of environmental protection. Up next, we have ecosystem services. Ecosystem services are the benefits provided by ecosystems such as clean air, water, pollination, and soil fertility. Measuring the economic value of ecosystem services can help identify the benefits of protecting and restoring ecosystems.
Last, we have greenhouse emission reduction targets. The greenhouse gas emission reduction targets are the goals for reducing the greenhouse gas emissions that are set by the Paris Agreement. Measuring progress towards meeting these targets can help identify the effectiveness of policies and measure aimed at reducing the greenhouse gas emission.
Environmental impact assessments. So, the environmental impact assessments are the studies that evaluate the potential environmental impacts of the proposed economic activities, such as new development or an infrastructure project. These assessments can help identify the potential environmental risks and opportunities associated with the proposed activity. Up last, we have corporate social responsibility reporting. As most of you know, what is corporate social responsibility? This reporting is a process by which companies report on their social as well as their environmental performance, which includes their efforts to reduce the environmental impact. The CSR reporting can help identify opportunities for improving the environmental performance and promoting sustainability. Here we come to the end of day 5. The link for the evaluation will be available. Please complete the assessment and stay tuned for day 6. Thank you.